Hey everybody, good afternoon and welcome to tonight's coaching session. Sound check please. Is there sound? Hey GB, how are you? Good to see you GB as always. Hope you had a good day. Nice couple of mentions in the room today as always. Young James, how are you? Hari, how are you? Welcome everyone. Let me know if there are any questions at all. On one of the boxes, stocks in play, wonder if you could explain the difference between the columns, like the volume weight and the range weighted, and if you're all in the current and cumulative columns. Yeah, Donald, good question. This is like an algo that was set up to grab stocks that are doing above average volume or putting in above average range. So that's why you get the volume weight, the range weight. So it's a good place to look for ideas. Honestly, I don't use it. I'm very visual as a person. So I have my gaps on my charts. Anything that I'm watching, I have on a chart. So I don't like to use lists like that because then it distracts me from what I'm doing. And it also takes time to look at a list one by one. So I like to, whatever I am watching, I like to put it on a chart. And that's why I recommend investing in real estate space, in monitor space, because then you have the flexibility and the availability, the room to put things on charts, and makes it a lot easier to watch and track rather than by keeping it on a list that you constantly have to click at. So that's what it is, okay? All right, but I don't really use it that much. I mean, I don't use it at all. Feel free to look through it during the day. I don't have a problem finding ideas. I have plenty of ideas at any given time, pretty much. So that's not an issue for me. Idea generation, What else? Any other questions? If there are no questions, we can just start with the lesson for today. But if there are any questions, feel free and I'll be happy to answer them. I thought today wasn't the easiest because the market was non-committal up until the end of the day. I mean, until later in the afternoon when it finally triggered. And when I came on the mic at 1 o'clock, I said the market looks higher for sure. And I noted the 15-minute buy setup, but I just wasn't sure it was going to really work. It ended up working. So if you took any of the long ideas, I don't remember what they were. I already closed out of my, like the thumbnail charts, but let's see. Clack was one of them. Look at that. What was her name? Michelle asked me what target was. I said the 200 for target one. What a perfect trail. Bar by bar, bam, out. Beautiful. Spike in volume, right to the flat 200. VG, I don't know if that worked. That didn't really work. Didn't go anywhere. What else was a good idea, but I didn't do it? PBI, I think, rolled over after the initial pop. Yeah, and then came back up, I guess. I'm not sure. Like I said, I closed out of my thumbnail charts today. What are my thoughts on the market long? It's very tough. It's a very tough call. Today's gap and the fact that we maintained it and didn't continue lower, that was, so that's bullish. Here's the thing that makes me a little bit bullish on the market. Notice how the initial bar, the first bar, was the biggest, and then the ensuing bars were smaller. That suggests continuation. Okay, that suggests continuation, but it's also going to depend on the overnight news. The Qs, because I thought about it. I thought about playing the Qs long last night. With my own eyes, I saw the Qs trading at the 200 in the after hours yesterday. So that was like a $4 drop in the after hours. It was trading at the 200. And so was Apple. Apple was actually down 8.2% yesterday. Not at the end of the day, but in the after hours. It was trading at the 200. Do you believe? At the 200. And then where did it open at today, this morning? Look at this. Look at the difference. I mean, it's like $10, right? It opened up here. So right now it's a news-plagued environment, which is the worst for the earnings plays. because as you saw this morning, all the shorts were gapping up, even though they reported probably bad numbers. They still gapped up, and then okay, later on they tanked, like the ENDP, the CHK, MNK, right? They got sold, but initially they gapped up. So if you exited at the open, which is not something I recommend doing, then you would have lost money on all three of these. At any rate, so it'll depend on the news, overnight news, if we get overnight news. But it does look higher if we can take out, let's say, 183.80 on the Qs. The SPY not as good, but it'd be the same issue over one or the same numbers, I guess, over 288.21. So possibly, continuation move up to the gap fill, which is up here. We'll see. I'm hoping we actually gap down tomorrow, or we trigger the sell setup and then continue lower. But I'm hoping we actually gap down. We'll see. The market is down just a tiny bit in the after hours, I think. Let me take a look. Yeah, the Q is down like 10 cents, right? So it might also depend on the earnings, but right now we don't have big companies reporting. I mean, Disney is the biggest company that's reporting tonight, and somebody said, I think Donald said, gapping down $4 in the after hours. At the moment, it's only $2. Well, 2.7, $2.70. That's not much. That's basically like not even 2%, right? So, but so we'll see what the market does tomorrow. What's important is always, when you're trying to determine whether the market is going to continue, or a stock going to continue higher or not, it's important to get follow through, right? If you don't get follow through, if you only get one green bar, that only goes to show you how weak the market really is. And my target on the Qs, if we were to continue lower, would be the 200 MA. Okay, would be the 200 MA. The IWM already reached that target, down to that prior pivot low. It didn't quite reach it, but almost yesterday, and bounced off of it, which makes it even more significant now. If we break under 146, let me just give you the exact number, 145.30. If we break under 145.30, this market will be in big trouble. And we follow through. Sometimes we break by a little bit and then go right back up. But I think now that we double bottomed off of it, not an exact double bottom, if we break under it, it will be for real. So that is what I would watch for, is the IWM, because the IWM is the leading index. It was the first one to top out last year on August 31st or something like this. Yes, August 31st was the high. If you look at the Qs, it was in October. So IWM is definitely the leading index of the bunch. And on the weekly, does that weekly chart look bullish to you? No, it doesn't look that bullish, right? It doesn't look bullish at all. The question is, did we rally enough to negate any bearishness? And the answer is perhaps, yeah. We retraced 60% at least. And so, if we can base here for like a couple more weeks, then for sure we should be rolling over. If we can base here, there's nothing for sure, as you know. But if we can base out here, then yeah, we should roll over. Monthly, same picture, basically. So again, the only thing that's questionable about the IWM is the size of the retracement. That was pretty significant. When you retrace 70% of the fall, usually it continues higher. It doesn't actually, it reverses the trend. But that's that's what I'm talking about here, is that 145.32. If we break under it, it'll be very significant for the market. Other than that, you can't really watch that much. I mean, the Qs, the SPY, the diamonds, they all look the same, right? And super bullish on the larger time frame. The fact that we got a peekaboo new high right here, meaning a new high failure on the monthly, suggests a retracement back to the rising 20. So to here, on the monthly chart to the Qs. But I'm telling you, the most important index to pay attention to at the moment would be the IWM. okay, would be the IWM, because it's the leading index and it's the one that looks different than the rest of the market, than the Qs, the SPY, and the diamonds, right? Disney, back up. It's not even down on the day, right, anymore. Things move a lot in the pre and post market, as you guys know. So Disney is no longer down, and so the Qs is no longer down. It was down just a little bit. Now the Qs is back to where it closed at. Okay. All right. What else? And now Disney's back down a couple. $1. Let me just see something here. Any other questions? DF worked. Yeah, unfortunately, DF was hard to borrow. I loved it. Remember, I said that's the best short. Let's take a look. But I didn't even track it because, I mean, I didn't wow. I didn't keep an eye on it because it was hard to borrow. What a play. I said 1 penny, 121 by 122, if you want to do it as a 1, 2, 3. I said 1 penny, no, that's 2 pennies. 1 penny stop is what I said. 121 by 122, that base. But really, I would have put it over 123. Wow. Totally worked. But you had to, I didn't have it. Did I do earnings? No. On Disney, I said there is no setup on the daily, right? I said it's really bullish on the larger time frames, the monthly, the weekly, but the daily, that's not a long. I mean, that's just not a long, right? A rising 20 into, I mean, a green bar into almost a declining 20. That's almost like a short. On the daily, that's almost a short. But I also don't short strong stocks. I wouldn't mind shorting something like this if it was at the lows. If we had a pop into the declining 20, then sure, I wouldn't mind shorting it. But also, it also had a flat 20, not a declining 20. But I don't short something like this. What about Planet Fitness? Because it had a similar pattern, but I thought Planet Fitness was much more bullish. I don't know if it's reported or if it reports tomorrow. But the same picture, not good daily, but really bullish on the larger time frames. I guess it's really climactic, maybe not that good anyway. Let's see. All right. Okay. Any other questions? So yeah, the Disney no play. Really don't like it. When the market gets volatile like this during earnings season. Do you guys remember when Greece was going through, was needing a bailout? Remember when Greece was basically going bankrupt, and the EU had to bail Germany mostly had to bail them out? Well, that I still remember to this day. It completely ruined earnings season. I don't mean just the earnings plays. I at the time I wasn't doing these earnings plays, overnight earnings plays. I was just day trading. Completely ruined the earnings season because stocks started the market became the main catalyst, right? Regardless of the quality of the gap, stocks would just follow the market. Market went up, they went up. Market dropped for the most part, like 90% of stocks at the time. And so I remember I had a really hard time during that earnings season. So I'm hoping we don't end up this earnings season doesn't end up like the last one, where the market just controls everything. And I mean, I was surprised today the gaps, right? The gap downs. I mean, the bear stocks all gapped up, and then got sold, but all gapped up initially. So at any rate, if there are no other questions, we can just switch to and do our lesson. It shouldn't be that long of a lesson. Right now we're talking about amplifiers. So it's not, they're simple, effective tools to add to your arsenal, but it's not, it doesn't take a lot of instruction on my part. So they're going to be, short lessons. Maybe we combine two of them in one session, but I don't know. We'll have to see. All right, so let's go ahead and get started. As you know, I broadcast this to social media, so Just bear with me for a second here while I prepare the broadcast or the live stream. Okay. It's going to take a second to set it up. And then we'll just pick up where we left off last week. Hello, YouTube. Please give me a moment while I go live on Facebook. I'll be right with you. And hello, Facebook. How are you doing? Hope you are having a nice week so far. Hope you had a good trading day today. This is Sami Abu Saad with the Strategic Day and Swing Trader. And we are going to pick up where we left off last week, doing our Tuesday night lesson series. Before I start, as always, a disclaimer to let you know that trading is risky and that whatever we discuss today is for educational purposes only. So make sure you agree to that before continuing this video. With that said, I also want to mention that I will be doing a free webinar, an amazing webinar tomorrow. So be sure to stop by. If you want to register, you have to register. There's a link in the description of the video. The first link in the description below. Click on that and register for tomorrow night's webinar. And with that out of the way, let's go ahead and get started. All right. So last week we talked about amplifiers, enhancers, whatever you want to call them. Things, events that make the setup even better, right? What kind of a setup am I talking about? In general, I'm talking about the buy setup, the pullback to a rising 20 MA, that kind of a setup. So what kind of amplifiers make it better? We started last week by talking about the first one, which is probably the most important one too, the bottoming tail. Or if we're talking about shorts, the topping tail. Now, why is bottoming tail such an important amplifier? Well, for that we would have to look at this slide from like the first lesson maybe we did 6 weeks ago or so, or even more, where we talked about how a bottoming tail forms. A bottoming tail initially is a red bar, is a big red bar. Here's how it forms, just so we're all on the same page. Here's how a bottoming tail actually forms. It initially, the stock opens when it's a green candle, then you know that the open was at the bottom of the green. So it opened here, was actually a big red bar, but before that candle had finished forming, the buyers showed up and forced prices higher to close at the top. So it's a complete negation of that bearish event, right? Of that big red bar, and a reversal, a complete reversal of that red bar. So not only, and this is why we say a bottoming tail bar is even more compelling or stronger than just a big green bar like this one, number one, because the bottoming tail bar, not only is it, it closes at the top here in this case, but it also reversed something that was really bearish, a red bar, a big red bar in this case. When you have a red bar, that means selling. It means the sellers are in control. In this case, not only did the buyers run them over, but they also trapped the sellers. Anybody that didn't cover on the way up is now underwater, which means as the stock starts to continues higher, they're going to be forced to cover. their covering should only propel the stock, push the stock higher. Does that make sense? So bottoming tails are important because it's a reversal of a bearish event. The bigger the and this is why the bigger the bottoming tail, the more significant it is. The wide range bottoming tails are called range expansion bottoming tails, REBT. Those are the most significant, the strongest reversal sign you can ever have. And you and I, small traders like us, individual traders, can't make a bottoming tail. You know who can? Wall Street can. Institutional money can. If you look at a significant bottoming tail, if you ever find a big bottoming tail and you look at the volume below it, you will almost always see really big volume, because it's institutional money that creates these kind of bars. All right. So bottoming tails are significant because not only is it a sign, not only is it a reversal of something that was actually bearish, but it also creates, it also traps the sellers. All right. And the bigger it is, the better it is. The more volume it forms on, the more bullish it is. The faster the reversal happens, the more also the stronger it is. Because the faster a bottoming tail forms, meaning let's say we get a drop and then an immediate reversal. When that happens, it gives the sellers no time at all, or very little time, I should say, to cover. If they don't cover, if they don't get the chance to cover, then they're going to be trapped. Trapped traders is what really moves prices, what moves the market. When they're trapped and the market starts to move up and they're now losing more money, they're going to look to cover. Their covering pushes the stock higher. The ones that didn't cover, that are still in it short, as the stock or the market moves up more, they're losing more money. They're going to cover, and it starts that vicious cycle. So bottoming tails are really signs that institutional money bought the stock, and so they're not to be taken lightly. We talked about how amplifiers make the setups more reliable. Okay, more reliable. So if we have a buy setup, is, we talked about it, what a buy setup is in previous lessons, but we need to have 3 or more red bars or 3 or more lower highs. Lower highs meaning this bar's high needs to be lower than the previous bar's high. This bar's high needs to be lower than the prior bar's high. If you have red bars, lower highs, and lower lows, that is what we call a smooth buy setup or pullback, a clean pullback. Those are better. The chance of a follow through from a clean pullback, the chances are higher than from a sloppy one. Am I right? Why is that? This is the most important question you can always ask yourself, is why? Right? Why? Because then once you understand it, then you won't need to remember it. It'll stick, right? If you understand something. But if you don't understand it, then you're going to need to memorize it, and it's not going to be good. Just saw in the comments, Facebook has no sound. That probably that person has no sound, honestly, but I don't know. Let's take a look. Can you tune in for a second, William, to see if there's sound on Facebook? You have none as well. Wow. All right. Well, not sure. I'm not going to restart, so we'll have to repost it, I guess, on Facebook. That's fine. Thanks for letting me know. I wonder why, though. Because you guys can hear me in the room. So I wonder if also... I think I know why. How about now? Is there sound on Facebook? I'll repost it anyway. Let's carry on. I'll repost it anyway. So if you're watching on Facebook and you just got sound, I will maybe just tune in later or just watch the initial few minutes when I re-upload the video later on. All right. So again, here we go. We need the bottoming tails that we're looking for are not the ones that come after just one red bar, right? We're looking for bottoming tails that come after 3 or more red bars, because that's what a buy setup is, 3 or more. Okay, we're not looking after for bottoming tails that come after just one red bar or come after one doji bar. So Facebook, sorry about that, but if you're able to tune in, great. I'm not sure if we had an issue with the sound on YouTube, but hopefully you're all good now. We're just basically getting started. Reviewing last week's lesson. I'm doing a webinar tomorrow at 4:30. Be sure to register for it. First link in the description. Again, first link in the description if you want to register for tomorrow's webinar. All right. So a buy setup with a bottoming tail equals a more reliable buy opportunity. So we give the buy setup 20 points on the ranking, the scoring system that we use. With a bottoming tail, now that buy setup becomes a 30-point buy setup, a more reliable buy opportunity. Here's what it looks like. Buy setup, bottoming tail, sell setup, topping tail, 30 points. Okay, 30 points. Entry, still the same as always, which is 1 penny above the prior bar's high, 1 or 2 or 3, however many you want. Usually the spreadier the stock is, the more room you want to give it. The DF, for example, from today, that trade, you don't need to wait 2 or 3 cents. It's a $1 stock, $1.20. So you short it exactly when it gets to 120. You don't wait until it gets to 119 or anything like that. Just 1 penny is enough. But a nice play, right? But on something that is, that's $100 or Disney or something like this, then I might give it a couple cents. And then so the entry, as I said, is 1 penny or so above the prior bar's high, stop is below it, and target is the prior high. Okay, prior resistance. As the stock puts in 2 green bars in a row, as soon as it finishes the second green bar, you go bar by bar. So you place your stop under that green bar's low. Once this bar finishes forming, you place your stop under it until you get to target, or you get a reversal bar. You get a red bar that takes out the prior bar's low, like so. Or you get a wide range green bar. If you get a wide range green bar, it's a good idea usually to get out. Something like this. You get a wide range green bar, usually a good idea to just get out. What does a bar by bar do for you? Well, you can see if it's if it has multiple bars in a row, you go bar by bar. Usually you get the top. Bar by bar, we ran out of time, but you'd still be in it. Clock, which was the 15-minute buy setup this afternoon, bar by bar would have kept you in it till here. That's pretty nice. You captured 90% of the move. Does that make sense? So bar by bar is the way to go when you have a momentum stock. If you have a sloppy stock that's not going anywhere, that just prints doji bars, well, you don't want to play that stock anyway. But if you do, then you can't use bar by bar. You have to you have to use pivots, right? You have to use pivots. That's kind of another lesson for another time, right? Completely different topic for another time. Here's what a buy setup looks like on a real chart rather than a graph. So you get the 3-bar pullback or more, and then the entry would be above it, stop under it, and target the prior low, the prior high, prior pivot high. A lot of times, if the stock is really bullish, it goes and keeps going. It exceeds the prior pivot high. All right, and if you go bar by bar, you could benefit by keeping just raising the trailing stop rather than exiting at the prior high. Now, in this case, you should by now know that this was not such a good buy setup, because we like buy setups that make it down to the rising 20 and to support. To tell you the truth, because of the really strong move up, if this had come all the way back down, then it wouldn't have been good either, because then it would have been basically a breakout failure on the larger time frame, the weekly chart. This is the daily chart. Does that make sense? So in this case, if it had come down to the prior low, it wouldn't have been good. Up here, a little extended, so not very good either. So sometimes buy setups are, they're not all created equal. This was a better buy setup that was ignited, that was triggered through a gap, which is even more bullish than just simply triggering the buy setup without a gap. When it happens through a gap, that's even more bullish. Bottoming tails, we don't want to look at every bar and say, well, there's a tail there, that's a bottoming tail bar, right? Or right here, there's a little tail, that's a bottom. No, it's not. But the bottoming tails that we are interested in are the ones that make up at least 50% of the candle's size. Needs to be made up in bottoming tails. Okay, at least 50% of the candle's size. So for example, this big bar right here with the little bottoming tail at the bottom, that's not a bottoming tail bar. That's not a bottoming tail bar. It's a little bottoming tail, but it's not, it doesn't mean it's a significant bottoming tail bar. Anything that has that is 50% or more of the candle size qualifies as a bottoming tail bar. The bottoming tail bars that we're interested in are the ones that come after 3 or more red bars, okay, or 3 or more lower highs, like so. So those would be significant, okay? So that's, I'm just reviewing last week's lesson, right? Topping tail, the same thing, right? Big topping tail on big volume, that's a clear sign of distribution, of selling. From there, the stock dropped. And then big bottoming tails there, 2 of them, that's a sign of accumulation, right? Institutional money stepped up and bought it. So bottoming tails are really good. We talked about all of that and more last week. This week, today, we're going to talk about the second amplifier that makes setups even better. And this is lesson number 20, actually. Wow. And it's called the changing of the guard. This is probably the most difficult one to understand. So you might want to really pay attention. All right? The changing of the guard. T3 is changing of the guard, COG, our second trading combination, is the name we have given to a multi-bar pattern that signifies that a clear shift in the balance of power has just occurred. There are 2 types of COGs, bullish COGs and bearish COGs. The bullish COG signifies that a change in control from the sellers to the buyers has just occurred. The bearish COG signifies that a change in control from the buyers to the sellers has just occurred. Before we show the potency of the price pattern when it is combined with the T3 buy and sell setups, it is necessary for us to explain the powerful reasoning behind the COG. We have already looked at this slide. Actually, the exact slide we looked at, is that it? In the past, before. This is what it was. Right? In like the first lesson we did, way back in March. Right? 4 months ago, actually. So we said that each time a stock closes above its opening price, each time you have a green bar, the buyers are considered to have won that particular battle, that particular bar. Each time a stock closes below its opening price, the sellers are regarded as the winners of that bar. The following formulas appear. If the close is above the open, it means the buyers won that bar. Demonstrate this clearly. Why is that? Why is it that we say that when a stock closes above the open, how can we be sure that that means the buyers are in control? Well, it's very simple. It takes buying to put stocks up, and it takes selling to put them down too. But in order for something to go up in price, you need demand. So if a stock closes above where it opened, it must mean that there was more buying than selling. And I know the age-old argument, but for every buyer there's a seller. How can you say there's more buyers than sellers? Yes, I know all of that, right? But it means that the buyers were the ones that were aggressive. It wasn't the seller. There was an abundance of buyers and limited number of sellers, limited amount of sellers or selling. It's like when you go to anything in life, right? But when you go to, let's say, the farmer's market or grocery store, if there's only 2 strawberry baskets and there's 50 people lined up trying to buy them, guess what? The price of strawberry is going up. It's going to go up. But if there were 500 baskets of strawberries and only 2-3 buyers, and at the end of the day, the producer would have, the grocery store would have to throw them away, then they're probably going to lower the price dramatically to entice people to buy. The same in trading, guys and gals. Exactly the same. Same thing. So it's all about buying buyers and sellers. That's why determining whether a stock has more demand than supply or vice versa is why we use technical analysis to begin with, is to actually determine whether a stock has more demand or more supply. Which is it? And we want to play stocks that have a clear winner. I mean, a clear group in control. Not, oh, well, there's about 49.3% buyers and 51.7 sellers. No, that means they're evenly matched. We want to focus on stocks that have a lot of buying, a lot of demand, and very little selling. Those are the bullish stocks, and vice versa when you're looking for shorts. Okay? So again, if a stock closes above the open, it only means that the buyers won the battle, that particular battle. In reality, there's more to it than what I just said, because sometimes the stock might be up, 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 and, well, let me just redraw this. That wasn't very good on my part. Give me 1 second. So if a stock is up a lot, like so, right? And then the bars are getting bigger and bigger, yes, that means the buyers are in control. But this kind of a pattern means there is euphoria, extreme greed, and it's not sustainable. So yes, if you're betting, if you bought the stock at any point while it was moving up, you made money because the buyers are the ones that are in control and the stock is moving up. But this is the kind of stock that you would expect at some point in the near future, like any day, any bar, it could actually have a real reversal, big time reversal. Why? Because that's also a sign of exhaustion, a sign of extreme greed when the bars keep getting bigger and bigger. It's like what was it, that climactic today that I mentioned? What was it? ALLK, wasn't it? ALLK. See this? I mean, isn't this the most bullish stock in the country right now, ALLK? It was, here's the daily chart, just so you have it, and just so you see it, ALLK. It was a $30 stock yesterday. On what's today? Today's on Monday. Yesterday gapped up 100%, and today it's at $80. It's at $80, right? It tripled in 2 days, pretty much. Okay, great. But that doesn't mean so why would you short something like this? Why would you look to short something like that if it's so bullish? Because it became climactic. We'll talk about the climactic setup in future lessons, but that's what this was. Up, 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 and this was the biggest green bar. Or a big green bar on the biggest volume. That again was a clear sign of exhaustion. That the buyers exhausted themselves, which means all the remaining buyers just rushed in all at the same time. They couldn't take the pain of not being in it anymore, rushed in it, and of course it topped out because there's no more buyers after that. Does that make sense? It dropped like $5 probably. Oh wow, it dropped $9. Can you believe it? That's from the entry. From the top, yeah, it dropped $9. The entry was at 84.12. Wow. 84.12 was the entry that I called out. Oops, I missed it. Here it is. Should be 84.12 right here. Stop 85.40. It dropped $9 or $10. That's amazing. Yep, $9 or so, almost. At any rate, so it is true that if a bar closes above above where it opened, that it is true that there was more buying than selling, but you also have to look at the context where this bar is forming on the chart. If it's preceded by multiple bars up, especially if it's extended, and especially if that last bar is a wide range bar on volume, that's what a climactic is. It means the stock is going climactic and exhausting itself. Okay, but back to what we were saying, which is if we get a buy setup plus a green bar, that's what a bullish COG is. Now you might say, wait a second. So you're saying 3 red bars, a green bar, that's a COG? Yes, as long as it doesn't trigger the buy setup. If it triggers, what does that mean, trigger? It means, if it takes out the prior bar's high, then it's not a COG bar. Something like this is still bullish, but it wouldn't qualify as a COG bar. Does anybody know why? Why is that? Something like this would be rated 20 points with a bar that triggers the entry right here over the prior bar's high. Something like that would actually get 10 extra points, and this buy setup would be a 30-point buy setup. Okay? Why is that? Why is it that a bar that doesn't take out the prior bar's high is given 10 extra points? And likewise, a red bar, a bearish COG, that doesn't take out the prior bar's low is given also, awarded 10 extra points. And the reason, my friends, for this is because the COG bar, the best thing about it is not the fact that it is so bullish. It's not the fact that, it's a green bar, it means the buyers took back the control. Yes, it means all of that. But the best thing about the COG bar is that it's a heads up bar, meaning on a bar like this, let me just redraw this, okay? On a bar when the stock closes, when the stock takes out the prior bar's high, like so, and triggers, you have to get in it right here. You have to get in it, and sometimes before the stock closes as a green bar, it comes right back down, and you end up basically taking a stop. Does that make sense so far? So far, so good. So when the bar triggers, you can't wait for it to close. You have to jump in the moment it takes out the prior bar's high. And sometimes you jump in, and it comes right back down, and you end up getting stopped out. But with the COG bar, it has to close below the high, which means you don't get triggered in. You don't get triggered in, and you already get a reversal. You get the heads up that the buyers have taken back the control. So that's precisely why it is awarded 10 points, because it tells you I'm bullish without you having to risk your money yet. Does that make sense? You don't even have to risk your money. Usually before you can get that kind of confirmation, you have to be in it. It triggers already. Before I can call a buy setup really bullish or really good, usually it has to take out the prior bar's high. But then I'm in it, and it may stop out. With a COG bar, I'm not in it, and it's already a big green bar. It's already a green bar, which means the buyers took back the control. And now, where's the entry on this kind of a buy setup? The entry, my friends, you should all know from all these lessons that we've done, the entry is always above the last bar's high. So in this case, not here, not above the red bar, but rather above the green bar's high. Stop right here. So it also gives you a tighter stop. Does that make sense? Similarly, the entry for this sell setup would be under the red bar's low rather than the green bar's low. Under the red bar's low with a stop above the pivot. All right? Okay, good stuff. So if we have a buy setup plus a COG, we get a more reliable buy opportunity, and it gets 10 extra points. Reverse for a sell setup, of course. So a buy setup, check this out. A buy setup plus a COG What else does it have though? So how many points is this? How many points does this buy setup get? Anybody? This buy setup gets 40 points because it's also a bottoming tail bar. Does that make sense? So it's a COG bar. Why is it a COG bar? Because it did not take out the prior bar's high. You're not in it yet. Plus, it's a bottoming tail bar. The great thing about bottoming tails is what we discussed, is that they're signs of a strong reversal, or it's a strong sign of a reversal, I should say. The worst thing about them is they may, your stop is big. They make for large stops. The larger your stop is, the less shares you can have. And the smaller the R to R, the reward to risk, because we as we know, reward is the difference between the target and the entry. That's called the R zone, or reward. Let's call it RE, reward. The difference between your entry and your stop, it's the stop zone, or the risk, RI. So the smaller the risk zone is in relationship to the reward zone, the better the play. Okay, it gives you, those are the ones that give you, when they work, they make a lot of money because you have small stop relative to the target. Does that make sense? So a bottoming tail and the COG makes this a 40-point buy setup. A topping tail, but where's the COG? There is no COG. Does that make sense? So in this case, there is no COG. It's just a topping tail. Got it? This is meant to confuse you. There is no COG. It's just a topping tail. In this case, that actually is only a 30-point play. Does that make sense? In order to get a COG, we need to have a red bar. So in this case, it's only a 30-point play. Over here, also, it's only a 30-point play because we don't have a bottoming tail. So enter over the COG bar's high, stop below it, target the prior pivot high. After 2 bars in your favor, go bar by bar. Until your target is met, you get trailed out, or you get a wide range bar, in which case just take profit. Let's take a look at a couple of real charts. This is such a beautiful chart. Cup and handle, obviously. A lot of you know this pattern as a cup and handle. What is a cup and handle in this case? It's just a rounding bottom and a transition A, right? Transition A breakout right off that newly rising 20 MA, that curling moving average, and then a small pullback afterwards to the rising 20. So you don't need to know, oh, this is a cup and handle or this is a head and shoulders. Just read the price action objectively. Nice healthy volume on the way up. When it pulled back or printed red bars, it did very little volume, which means very little selling. This was a COG bar because it was a green bar after 3 or more red bars and did not take out the prior bar's high. So that's actually a COG bar. In theory, that's your target, but you know better. That's not the target. That's nothing. It should blow through it. And then go bar by bar, which would have kept you in it. You'd still be in it up here, meaning it doubled from 250. Look at this, 550. It doubled, and you'd still be in it on a bar by bar basis. This is what I like about low price stocks. I know a lot of the people with small accounts that trade options don't like small stocks, obviously, because they're not optionable. But this is what's nice about them is, show me a $500 stock that doubled in a matter of, this is a weekly chart, 1, 2, 3, 4, 5, or 6 weeks. It's very hard to find something that doubles. That's a $100 stock, $200 stock, $500 that doubles in 5 weeks. But it's not very hard at all to find a 1, 2, 3, 4, even $5 stock that doubled in a matter of 5 to 6 weeks. So low price stocks, penny stocks are great when they're clean. Oftentimes they're not very clean or they're not very liquid. But when it's a clean, liquid stock, then beautiful. Why not? I have no bias against penny stocks or large price stocks, high price stocks. But high price stocks, oftentimes they get really spready. So it's hard to play them, to play the actual stock, unless you do it with options. Another buy setup here with a COG at the rising 20. So it actually is more than a 30-point play, because there are other amplifiers, but we haven't covered those yet. We'll cover these in future lessons. But this was actually a buy setup with a COG, with a narrow range bar, at minor support, at the rising 20, and at the 40 to 60% retracement. So it's like a 70-point play. I didn't really keep track of how many amplifiers, but almost a 60 or 70-point play. All right, we'll learn the other amplifiers in future lessons. For now, a pop quiz. How about that? A pop quiz for you. I know you're not gonna play along, but just do it on your own. I'll give you a minute. Find and circle 3 COGs, changing the guard bars. Find and circle 1 breakout, T3 breakout, and find and circle all buy setups. So I'm giving you 30 seconds, 20 seconds, 10 seconds, and here are the answers. Okay, here's the answer. First, COGs. It means we need a pullback plus a green bar. I can't really tell if this is a green bar or not, because it's just very small here on my end. You might be able to tell, but if this was a green bar, then it would be a COG. But I don't think it's a green bar. If it's not a green bar, then that's not a COG. That is a COG bar. Okay? That is a COG bar. And this, I don't know if that's a green or not. If it's green, I can't tell. Then it was a COG also. Okay? So that's 3 COGs. 1 breakout, it's actually already marked for you, or here it is. That's a breakout with a shakeout right off the 20 after the stock transitioned. See that nice curling 20 was downtrending, pointing down, and now uptrending. That's a breakout. And then all buy setups, well, there's one that hasn't yet triggered, or we don't know, maybe it triggered. I'm sure it did. When you have 45-degree moving averages like this, railroad tracks between the two, moving averages, the 20 and the 40, it's just the best kind of trend you can ever have. Buy setup right here, buy setup right here, buy setup right here. Got it? So this was a really pretty chart. Except for the sound, I hope you enjoyed. At the beginning, there was no sound. I hope you enjoyed today's lesson. If you did, as I said, there is a link in the description where you can join me tomorrow for an hour-long webinar, really important webinar, at 4:30 tomorrow. You have to register for it, so be sure to click on the link in the description. Be sure to also check out the other links. If you'd like to be part of the Strategic Day Trader, you can check us out if you've never been part of my room for just $49 for the next 30 days. I mean, what better deal can you have? 30 days for just $49. No commitment, cancel anytime, right? So that's the Strategic Day Trader room. I don't like to talk about myself. I like to let the results speak for themselves. Unlike many other people out there, I don't like to brag about myself. I like to let the results speak for themselves. But the Strategic Day Trader room, formerly called the Black Room, won the award as the best trading room in the nation, as voted on by the trading public, not by me or T3, by the trading public, for 2 years in a row when Trader Planet was running that competition. So we'd like you to join. We invite you to join. Check it out. And if you have any questions, reach out to customer service. Thanks so much. Again, hope you enjoyed today's lesson. I will probably be taking down this lesson and reposting the one with the sound, since we had an issue at the beginning. But thanks so much again, and have a great rest of the week. Take care, everybody.